saying goodbye to 2025 and welcoming 2026. Happy New Year, friends. The Greater Toronto Area real estate market in December can be summed up in one sentence. Prices have hit new lows again, transaction volumes have dropped to the limit, and the market is in a state of being suppressed. In December, the average transaction price in the Greater Toronto Area was only $1,007,000 Canadian dollars. This marks another new low following the declines of the previous months, and it also means that GTA home prices have, overall, returned to pre-pandemic levels. If you look back at the price curve, the current average price, just over $1 million, is roughly equivalent to where things stood at the end of 2019 or the beginning of 2020. In other words, all the extra value added during the 3 years of the pandemic has basically been absorbed by the market. In December, only 3,697 units were sold, which is not only a significant drop from November's 5,000 units, but also nearly 9% lower year-on-year. This shows that the decline isn't just a seasonal adjustment. Along with the drop in sales, there's also been an increase in new listings. In December, only 5,300 new homes were put on the market, which is half the number listed in November and almost the same as the same period last year. This indicates that the market hasn't seen a new wave of panic selling. As a result, inventory has also dropped back to the level of 4.6 months. But this decrease is mainly due to seasonal factors, not a rebound in demand. What's really concerning is that the average number of days on market in December increased to 65 days, not only 9 days more than the previous month, but also significantly higher than the 55 days during the same period last year. Based on my years of experience preparing monthly reports, it's extremely rare for the average days on market to exceed 2 months. This clearly shows that homes are becoming very hard to sell. In summary, in 2025, the Greater Toronto Area only sold about 62,000 homes in total. This is the lowest annual sales volume in the GTA in nearly 25 years, returning to levels last seen around the early 2000s. But the key issue isn't that this hasn't happened before in history, it's that the population has changed. This is really worth thinking about because over the past 25 years, the population corresponding to the real estate transaction volume has changed dramatically. In 2000, the Greater Toronto Area had a population of only 4.8 million, but today, it's already grown to nearly 7 million. That's a 40% increase in population. But transaction volumes have gone back to what they were 25 years ago. What does this tell us? It shows that it's not that demand doesn't exist, but that the real demand for home buying that should have appeared has been suppressed, has been delayed. So why has it been suppressed? The answer is clear and harsh. Even though the benchmark interest rate has dropped all the way from 5% to the current 2.25%, buyers still don't dare to make a move. There's only one reason: uncertainty about the future economy and a lack of confidence in stable employment and income. This sense of insecurity has outweighed the stimulus from lower interest rates and is clearly holding back people from buying homes. Based on all the data we have right now, 2026 doesn't have the foundation for a full rebound, but at the same time, there aren't the conditions for a continued systemic decline either. What really determines whether the market can thaw isn't just interest rates themselves, but whether the following key factors can all be met at the same time. First, inflation must stop worsening and not start rising again. Otherwise, if inflation rebounds, the central bank will once again face pressure to raise rates. The real estate market, too, will be the first to suffer. Second, the stability of the job market and household income expectations is crucial for buyers. Buyers need to feel confident that their jobs and cash flow will be secure over the next year before they're willing to make such a long-term commitment. As for interest rates, they need to at least stay at their current low levels or even be moderately reduced, or if there are no new major economic or geopolitical shocks before these conditions are met. What's a more realistic and likely scenario? It's that housing prices will continue to fluctuate at low levels and transaction volumes will remain sluggish. As for the market recovery, it's going to be a long-term tug of war. The current market isn't set up for speculators, it's for people with real housing needs, those with stable incomes and long-term plans, people who understand where we are in the cycle, not those who just chase after market sentiment. I'm Priest, specializing in buying, selling, and upgrading in the GTA. Click my profile to visit my homepage and let's discuss your next move. See you soon.